because the IRS really loves to confuse people with their stupid rules that are completely unnecessary. So when it comes to the Roth IRA withdrawals, you need to know the two categories. So there are the qualified distributions, and then there are the non-qualified distributions. And what you want is the qualified distributions, but you should also know what's considered a non-qualified distribution. Now, I'll get into those in a little bit after I briefly explain the 5-year rule. So the biggest oversight is probably the 5-year rule, which is to have your Roth IRA open for at least 5 years, even if you're over the age of 59 and a half. So what that means is that, let's say you open your Roth IRA at the age of 57. Okay. So let's say at 57, this is you opened it, and then now you are, say, 60 years old. Okay. So let's say you're 60 years old, and you can take the Roth IRA contributions out at any time, tax-free and penalty-free. That's regardless of your age, because you already paid taxes on it, right? But here's the catch. If you withdraw your earnings before your Roth IRA has been open for at least 5 years, even if you turn 59 and a half, you're going to get hit with taxes, not penalties, but income taxes. So you may have turned 59 and a half. In this case, let's say you turn 60, but you only have your Roth IRA open for the last, let's say, 3 years. Then you still have to wait another 2 years to withdraw the Roth IRA earnings tax-free. So let me give you an example. Let's say you put $7,000 into your contributions, right? So that's your contributions. And then you got $1,000 in earnings, okay? So 7,000, that is something that you already contributed to it. So that's gonna be your contributions, okay? And remember, the contributions will come from your checking account. So that is all in after-tax money. So what that means is that you can take this money out tax-free, penalty-free, at any age. Doesn't matter if you're 5, if you're 7, if you're 22, 30, 60, 55. 7,000 is what you put into your Roth IRA from the checking account, right? That makes sense. But the $1,000 here is what you earn by, let's say you invested in something like an S&P 500 ETF. So you put that money in there, over time you have 1,000 in there. So this is the earnings that you cannot withdraw until you're at least 59 and a half, open Roth IRA for 5 years. Okay, so you gotta have those requirements. So after 5 years have passed, if you don't actually, you know what? If you don't have the Roth IRA open for 5 years, this $1,000, you're not gonna get penalized for 10%. There's no 10% penalty, because in this scenario, you're already over the age of 59 and a half. But because you don't have the Roth IRA open for 5 years, you're gonna get the Fed and state income taxes. I'm in the state of Nevada. I live in Las Vegas, so I don't have state income tax. But if you're in a state with, with a state income tax, you're gonna end up owing state and federal income tax for the $1,000 that you withdraw. Okay, so when you take that distribution, if you take out all $8,000 in there, you're gonna be taxed for the $1,000 earning if you don't have the Roth IRA for 5 years. But if you're over the age of 59 and a half, you have it open for at least 5 years, then you can just, take that money out tax-free and penalty-free. And that's why if you're in your 20s, 30s, 40s, 50s right now, open up your Roth IRA and contribute to it. Okay, the 5-year clock will start the day that you contribute. And remember, if you're trying to catch up to your Roth IRA today on March 5th, 2025, at the time I'm recording this video, let's say you want to contribute to the 2024 Roth IRA contribution limit, let's say it's 7,000, then your clock will actually start on January 1st, 2024. So if you haven't seen that, just log into your Roth IRA right now. You're gonna see 2 boxes here, okay? One of them, it's gonna say 2024 contributions, 2025 contributions. And the limit is going to say on the right side, it's going to say 7,000 or 8,000 if you're over the age of 50. And same thing for 7,000 and 8,000. If you have Vanguard, they do a pretty good job at telling you how much money you have left for that contribution here. And let's say you open a Roth IRA today, this is what you're gonna see: 2024 and 2025. Let me center this up, okay? And when you see it, you wanna contribute first to the 2024 as much as you can. You wanna get to that 7,000 or whatever you can afford, okay? If you do $1 right now on March 5th, 2025, okay, let's just say you put $1 in there, your 5-year clock starts on January 1st, 2024. How amazing is that, right? But if you put money in there for, let's say, $1 in 2025 today, and you forget to do the 2024 one, your clock will start on January 1st, 2025. So this is really key. But if you're watching this video after April 15, 2025, this is going to disappear. You're not going to be able to see this. So April 15th, 2025 is the last day that you can go back to the Roth IRA 2024 and put money in there so that the clock will start on January 1st, 2024. And that is the nice thing about the 5-year clock, because it's not always about 5 years depending on when you start, right? And so again, if you're watching this video after April 15, 2025, then you do not get to backdate your 2024 Roth IRA contribution. So just keep that in mind. But in this case, you can go all the way back to January 1st, 2024 if you open the Roth IRA now and make the backdate contribution. That makes sense so far, right? Now, let me talk briefly about the qualified distributions versus non-qualified distributions. When you do a qualified and versus non-qualified, okay? Qualified distributions, before I get into that, there's a chart on the IRS website about the exceptions to tax on early Roth IRA withdrawals, and I'll put that link in the description below. And before I go over this, I want to make it clear that I never recommend taking Roth IRA out early unless you're retired from the workforce. My course members know that Roth IRA or Roth is the last thing they want to withdraw because of the tax-free growth, right? My priority starts with tax deferred and after tax, and then Roth in that order when it comes to retirement withdrawals. You can always schedule a consultation with me by visiting firesignature.com/consultation. But anyway, a qualified distribution from a Roth IRA means that you can withdraw your investment earnings with no taxes or penalties. So some of the qualified distributions will be your 59.5. You had it open for at least 5 years, right? And if your withdrawals were due to disability, okay, or if you're using it to buy a house, up to 10K. That's lifetime. That's $10,000 in lifetime limit. So if you're looking to buy or build your home, your very first home, for up to $10,000 in lifetime limit is what you can take out of your Roth IRA tax-free and penalty-free. I still do not recommend using a Roth IRA to buy a house because I want to leave that Roth IRA alone for my retirement. Now, I'd rather use cash or after-tax accounts like the taxable brokerage account to save for a down payment. Otherwise, I'm gonna miss out on the tax-free growth. So I'd rather wait a little bit to save for a down payment if I have to. And a non-qualified distribution here means that you do not owe the 10% penalty, but you're still gonna owe federal and state income taxes, okay? So non-qual, 10% penalty waived, but you will owe Fed and state income taxes. So it would be something like unreimbursed medical expenses that are more than 7.5% of your adjusted gross income, or AGI. And if you don't know how to calculate your AGI, just look at your most recent 1040 tax filings and it should be on there, or talk to your local CPA. You can also take a Roth IRA non-qualified distribution if it's for the cost of your medical insurance, but only during unemployment. And if you just lost your job because you're a federal employee, that's something that you can look into if you don't have any other way to pay for your medical insurance. And the other one is if you're using a Rule 72T, okay? So 72T is also known as the substantially equal periodic payments from your Roth IRA, or it's also known as SCPP or SEP. You can also use it for qualified higher education expenses. And this is a new one that will be from Secure Act 2.0. And that's if you're a survivor of domestic abuse, then you can take non-qualified distributions from your Roth IRA. And if you are a reservist in the armed forces on contingency orders, can also waive the 10% penalty. And there are so many other ones that listed on the IRS website, so I'll make sure to put it in the description below. Either way though, what I want you to do is, if you're just starting out, I want you to really, really keep track of your Roth IRA contributions and earnings. Separate those, okay? Because when it comes to taking money out of your Roth IRA, it's going to start with your contributions, and then the next one will be your conversions, rollovers, and your earnings will be very last. That's how every Roth IRA is structured. But in any event, you want to keep track of what you have in your Roth IRA and your earnings so that you know how much of that you can touch, especially the contributions if you decide to retire early, let's say at the age of 55. Then you can touch your Roth IRA contributions, but you want to leave your earnings alone. And Roth IRA is a very powerful tool because of its tax-free growth, right? And tax-free distributions. Even if you're in debt right now, I would open a Roth IRA and just put $1 in it and to get the clock started, especially if you're in your 50s right now, because you don't want to wait until you're in your late 50s to realize that you don't even have a Roth IRA open. And if you're ever in doubt about how to get started with your financial independence journey, you can go to firestarter.com/resources to get your free FIRE checklist and use my compound interest calculator. And if you're thinking about taking money out of your Roth IRA, I want you to find other alternative means as much as possible, because taking money out of your Roth IRA means that you're going to have a slower growth in your retirement funds. I don't touch mine. I'll never touch mine until I'm at least 59 and a half. Now I've already have my Roth IRA open for over a decade. How about you? Let me know in the comment section down below.